Hello and welcome to Personable, a podcast focused on speaking to the world's best, enabling you to become the best you can be. My name is Harvey Bracken-Smith, and today I'm honored to be joined by my good friend Luke Sloman on this episode of Personal Markets, in which every week I aim to speak to a hedge fund manager or an expert in the space, Luke being someone heavily interested in this space, just like me, on real-time market news. So Luke is a third-year business and management student at the University of Exeter, currently spending his year abroad at the University of Sydney. He grew up in Tokyo until the age of 13 before moving to the UK for boarding school. His academic interests focus on finance-related modules, which complement his broader studies in business and management. I think this is his fourth time on Personable, which we were discussing just before. In terms of what we're going to discuss today, the S&P 500 is reaching all-time highs, alongside many other indexes doing incredibly well. So we're going to go into more detail on that. Great earnings for the Magnificent Seven, gold and silver reaching all-time highs, a high probability of a Fed rate cut, still in government shutdown, PE ratios, talking about the best times to be in the market, the Trump-Xi Jinping deal with the USA and China, and also Trump's latest with Canada. So lots of exciting topics to dig in today. The first one that I wanted to mention before going off to Luke, so with S&P, is actually, although it's up, I think, like 15% for the year, it's still underperforming internationally. So a benchmark for international equities is on pace to outperform the S&P 500 by the widest margin since 2009. The MSCI All Country World ex-USA Index, which tracks developed and emerging market stocks, is up 26% in 2025 on a US dollar basis. That bests the S&P 500, which is up 15%, heading towards its weakest annual performance since 2022. In contrast, South Korea's KOSPI is up 64%, Germany's DAX has increased 22%, Japan's Nikkei 225 has climbed 24%, and the UK's FTSE 100 has risen 18%. So a lot to throw at you there, Luke, but just in terms of the markets, could you paint a better picture for us what's been going on?
First of all, again, thanks for having me back. Fourth time now, so almost like a regular. But so as you briefly mentioned, the S&P 500 is at all-time high, and it's not just even if we look away from the American markets, we're seeing all these indexes across the world doing really well. Um, you threw some numbers out there. Nikkei's up over 20%. Germany's up, I think, over 10%, as you said. And I think a lot of these markets are interlinked with one another. So, for example, when the Fed cuts were announced last month, the last Fed cut, the Nikkei, for example, rallied because there's a lot of their Japanese company supply chains and market and their exports are in the US. So it is all interconnected in some ways, but also there's certain industries which have been doing really well, such as AI. Um, with deals from last month with Nvidia, Oracle, OpenAI, and a surge in semiconductors amount demands. A lot of these tech companies are doing really well, doing really well, and that's helping, drive this rally across the global markets. Um, and of course, the expected Fed cuts or that are going to occur at some time this year are also, helping to boost sentiment and give investors confidence that this upturn is going to continue. And that's also one of the reasons why a lot of these companies are valued at where they are right now. Um, Also, but there are questions about if the valuation has been stretched with, AI companies, tech companies. Some people are saying these companies are overvalued, and it could be a point of concern where in the next 1 or 2 years there could be it's almost like a bubble. It's been described as a bubble, so it's a bit of a concern that what will happen if that bubble gets popped. But for now, record highs pretty much across the globe, and I don't see it stopping in the next couple of weeks at all. As with the Fed, especially if the Fed's cut the interest rates as predicted.
Yes, I just wanted to add some thoughts on why the individual indexes have done particularly well. So with South Korea's KOSPI up 64%, as you mentioned, a lot of this has been due to AI and also the semiconductor sector. Companies like Samsung Electronics and SK Hynix, if I'm saying that correctly, have led them to do incredibly well. On top of that, partnership between these firms and OpenAI has led to a surge, a 3 to 10% single day surge, and more, which is doing very well. Yeah, a lot of it seems to be from the AI. Another angle is earlier in the year there was political turmoil. I think the Prime Minister of South Korea was ousted after trying to make. He basically elevated the status of the country into a police state, but the government ended up kicking him out. And the new unified government under President Lee Jae-myung, if I'm saying that correctly, after he was elected, he rolled out investor-friendly reforms such as slashing trading fees by up to 40% and addressing stock market valuation. The IMF upgraded its growth forecast to 0.9%, and also the likelihood of easing US-China relations, particularly after what Scott Bennett was saying in the last few days, gives them a high probability of export-heavy sectors such as autos and electronics doing very well. But that broader enthusiasm has spilled into the likes of defence, aerospace, and biopharma. Germany's DAX has also done well. I mean, earlier in the year, they announced their stimulus package. And so many of the firms as well from AI have done particularly well in AI software and industrial parts, which has added 214 billion euros in market cap. And then lastly, Japan's Nikkei. They have also done incredibly well. There's been many corporate governance overhauls, such as pushing firms to boost shareholder returns via buybacks and dividends. There's also been solid economic growth, with a Q1 GDP beat of 0.4%. And on top of that, it also seems to be the US China trade talks. I think what's most interesting to me is probably the UK's FTSE, up 18%. I think there's been a lot of talk, particularly on my end in the US, about just how bad the UK has been doing. But for its stock market to, outpace normal returns at 18%, I think is pretty insane. It says about 75% of earnings come from overseas in USD, so a stronger dollar with the pound down to $1.22 from 1.34, and rising commodity prices with gold and silver at 14 years high have supercharged miners such as Fresnillo up 140% and Glencore. We're also expecting more Bank of England rate cut expectations, and robust corporate earnings in banking, with Lloyd's up 38%, retail next up 28%, and defence, and even companies like Rolls-Royce are up 100%. I wonder if these tailwinds stay behind us. Interestingly, for the past, I just wanted to say all of that just to add context, but there's been a lot of talk from YouTubers. I know usually if I said this to you a couple of years ago, you'd probably think I'm, saying this as more of a joke. Why are you looking at YouTubers? But I think as initially kind of catalyzed by GameStop a couple of years ago, and I think in recent times there's kind of been an even bigger rise of retail investors being serious market participants. So you've got to look at where people are getting information, right? From Reddit, from X, and from YouTube. And when I went to do research for this yesterday, as well as looking at, more formal means of research, like the Wall Street Journal and the Economist, the Financial Times, etc. Going on YouTube, many of the thumbnails, so for those that don't know YouTube, the kind of image that pops up when you look on a video, was saying market crash incoming, market crash, market crash. And to an extent, an interesting stat that I saw is that the current market P ratio stands at 39, which is significantly above the 50-year average of approximately 23, with this level being higher than the peak of the 2008 financial crisis and the 1929 market crash. But I wonder to an extent whether you think, Luke, whether you think there is a market crash coming or some form of correction, whether you think it's fair for people to kind of spread fear into the markets that, is this going to happen soon? Is it going to happen down the line? Is it going to happen at all? I mean, even since COVID, people have been saying this crash is or isn't coming. So yeah, what do you make of this kind of impending market crash that a lot of people keep talking about?
Yeah, I think one of the reasons why people might suggest that there might be a market crash coming is if you look at just historical trends, there seems to be a big crash every 15, 20 years. So now the last one was 2008, which is in that range 15, 20 years ago, and what the previous one was Asian markets in the 90s. So some people might suggest that it's about to happen. If you just look historically, but also um, people. I've seen a lot of talk about you know us being in a bubble with because of the I touched on it uh, slightly earlier, but because of the AI and tech companies being overvalued. Um, and yeah, I mean, if you look at these companies, their valuations have skyrocketed over the last 1, 2 years. Um, and there's a lot of questions as to whether as to whether they are massively overvalued. A lot of these companies have partnerships into one another, which is have pros and cons, right? If a lot of these companies are invested in one another and have got partnerships, it fosters collaboration, and it can help the US companies to sort of gain a monopoly over other companies, because the US and China obviously are sort of in a AI tech like not well war is not the right word for it, but innovation war, I guess you could call it. Um, and by having all these companies collaborate with one another, it means that that the tech industry can grow as a whole, because tech, we all know, is a very wide ranging industry, and if you have someone who specializes in a certain area collaborate with another area, it can only mean good things. However, there is risk, because if all these companies are invested in one another, if one of these companies all of a sudden start failing or perform really poorly, then it will affect the other companies as a whole. So, for example, Nvidia and OpenAI. Nvidia owns shares in OpenAI, and right now looks great. Everyone think about how many people use ChatGPT. It's still growing. People use it every day. Nvidia as well. It's got a monopoly on the AI GPU market. But if all of a sudden OpenAI starts doing well, starts underperforming, or vice versa, then it can have serious implications on the other company. So there's definitely a concern over the valuation. But saying that, it's not all doom and gloom. I think if you look at earnings, that US corporate profits remain very historically strong. I mean, especially in the energy, tech, and financial sectors. And there's if you look at global liquidity, capital is still flowing into equities, um, particularly from Asian sovereign wealth funds, but across the whole world, it's still very high. So um, there is no. I don't think there's much concern that it's going to be imminent. It's maybe more looking into 1 or 2 years in the future. But as well as this, the Fed cuts are on schedule, so low yields will keep stocks relatively attractive compared to bonds. So there's still that investors will still be willing to, buy these stocks instead of moving to bonds. So I think it's definitely an area that needs to be kept an eye on, because a crash would have, detrimental consequences to a lot of people worldwide, and it will affect a lot of people's standard of living, and certain businesses might fail. But I think there's no danger of it happening in the next couple months, for example.
Oh, bold prediction, Luke. Will we
Yeah,
hopefully?
hopefully we don't come back in a couple months and
Yeah,
yeah.
yeah, hopefully not. No, I think you gave a really good balanced view on both sides there. I just kind of want to both echo back what you were saying, but also to add to it a little bit. Something that, there's often this thing that, particularly older people, they think that listening to more experienced investors and older people are oftentimes better to listen to because they've experienced more before, they've had, yeah, more experience, more time, more exposure, more news they've read, more things they've been able to react to. But I also think that a youthful mind can be really good because they haven't been exposed to as many things before. So things that should be obvious to an experienced investor that's never come across something before, to a new investor, it's the most obvious thing in the world. So something like AI, for example, I feel like our generation is much more digitally native than, say, the older generation. So when I or you look at a social media app, or when a big company says they're using AI, we can tell, is this simply just an addition to the platform? Like they've just basically got a plug-in, they've got a subscription, they've added it onto the platform. Or is AI actually ingrained to what that company do? Is this fundamentally changing the business of what this does? And I was listening to a podcast with Alfred Lin, who is the Midas 100 top investor in 2025, and he's invested in companies like Airbnb and DoorDash, and very impressive companies like that. And even looking from a private market side and public, he says that if you say AI, you're obviously going to get higher valuation. I think that's something that both me, you, and the listeners know. But something interesting that he said, which I literally just said, was if the AI is not fundamental to what you do as a business, and if there is not a way in which you can have an edge, and that being the data, we discussed this a couple of weeks ago, that being the data that you have. So, for example, if you're a bank, you have data that other people don't have access to. If there's not a way in which you have some form of edge over OpenAI, then that shouldn't give you a premium over OpenAI. And in the future, you'll probably be replaced by AI. So I think it'll be interesting to see, we talked about the South Korean economy, we talked about the UK economy, the German economy, all of these being massive beneficiaries with AI, with OpenAI of Nvidia. So whether that continues, not simply because, as you said, that Nvidia and OpenAI do well, but also whether these companies actually have an edge in what they're doing, or if they're simply just benefiting from using the term AI. The other reason I mentioned the youthful mindset is if you were to ask investors for the past 50 years, and now for the past maybe 1-2 years, how would you hedge your portfolio? As well as saying bonds, many of them would say gold. And in the past 1 to 2 years, many of them would say Bitcoin or other cryptocurrencies. And it's kind of gone from a point where you look at gold and you'd be like, what price do I want to invest in it at? To a lot of investors actually see gold as a set, like a 1% of their portfolio, for example. But although many investors are like, oh yeah, it's just 1% of my portfolio, it's always a hedge. If you look at how well gold has done in the past few years, I mean, it's even going up to $4,500 an ounce. Is there no point? I mean, this from my perspective, my youthful mindset, is there no point in time in which we say, all right, I get that gold is a hedge, I get that equity's up such a large amount, but is there no point in time in which we say, hold on a minute, I know gold is a hedge to fiat currency, I know it's a hedge towards what's going on in equities, but it has reached such high valuations relative to historical levels. Is the price actually justified? And I think that's a question we need to ask. And I think it's also a question we need to look with Bitcoin. Like I think it's unreasonable to say that every single time that the government prints more money or that the US economy doesn't do well, that Bitcoin is the only beneficiary of that. And maybe to an extent it is. Maybe Bitcoin doubles in price, but should it 5x, should it 10x, should it 20x? That is a question that I think needs to be asked. Another important point that I saw the general managing partner. I'm going to say his name wrong, say Boyfer or something like that. He's like a South African entrepreneur. He's the head of Sequoia Capital. And a point that he's made recently is that in venture capital, there's way too much money in the market. When I first heard this, I was like, you're just trying to, stop your competition. Less VC money out there, less people investing in these companies, and so therefore less competition. And I still stay true to that. I think he's trying to have less competition. But I also think that there is so much money in the world right now, both in private and public markets, that the degree to which you can find things, particularly in VC, is a lot harder to find than in public markets. And if you look at how well the stock markets have done, with South Korea up 60%, the US up 15%, UK up 18%, Germany up 22%. If you look at those numbers, will this continue to go up? Maybe, potentially. But also, is there an extent to which there's too much money in the market and all of these companies are being boosted so much, not simply because the underlying company is doing well, but just because there's so much money? I mean, we even saw that Trump announced earlier this year that every newborn in the United States was going to be given a little bit of money invest in the S&P 500. So all of this is kind of contributing to the overall price of these companies. I mean, even South Korea, which I just mentioned before, the leader of the country announced measures to make it easier to trade stocks and also easier to invest in index funds. So the underlying companies haven't changed much, aside from AI, which relies on Nvidia and OpenAI doing incredibly well, but also that the actual conditions for trading have got better. Another thing I wanted to mention real quick, aside from gold, is silver. Silver's also reached incredibly high levels. In the past 2 weeks, there's been what's known as a short squeeze. If you don't know what that is, it's essentially a system in which people are betting against silver. So what they do is I go to Luke and I say, hey, can I borrow your shares of silver at $100? And then in a couple months' time, I will have to give those shares back to Luke. But so if I borrowed them from him for $100 plus a premium of say like 1%, and in a couple months' time the price goes down to $90, I get them for 100, I sell them to someone else, and then when I owe Luke back his shares, I buy them back at $90. So I've made $10 minus whatever the premium is. But what happened with silver is many people did that, and let's say using a baseline of $100, it went up to $110. That gets to a price for investors that they've actually gone and lost an amount of money. So what happens is they have to, when it gets to $110, they've obviously lost 10%. And so they have to go and buy it back. And when you buy back the shares, it pushes the price up even more. And one of the big problems with short squeeze, you might say as like a retail investor, if you listen to this, 10% isn't that much. But a lot of more what they'll call sophisticated investors will use leverage. So instead of their exposure being 1x, so when it goes up by 10%, they've lost 10% of the money, they might lose 20% of their money if they're 2x or they're 4x or 5x, so lose even more money. The last little thing I wanted to mention with regard to market crashes and what's going on in the market, Luke, you actually pointed to this, which I think is very important to note, is that it's not just how high the valuations are on an abstract level, but if you actually look at the earnings, so for example, for Q3 2025, the Magnificent Seven are expected to post 15% year-over-year earnings growth, compared to just 6.7% for the remaining 493 companies in the S&P 500. So although the growth is so concentrated, it is those 7 companies that are getting the earnings growth. I mean, that's almost double or even triple the amount of earnings growth as the other 493 companies. And I think we spoke about this in the past. Is like if you look at Apple, for example, Apple AirPods could basically be its own S&P 500 company. And so I think investors need to look at not just, oh, is it the Mag 7 versus the other companies, but it like all the different business lines within the Mag 7 as they continue to grow, drive growth forward. Moving on, market participants have priced in a near certainty of a 98% probability of a 25 basis point rate cut at the Fed's meeting on October 29, 2025. In recent speeches, Fed Chair Jerome Powell has signaled this shift, stating that the labour market is softening and the bigger risk to rising unemployment. This indicates the Fed is prioritising its full employment mandate over inflation concerns, especially as the September CPI report came in cooler than anticipated. Luke, could you add on a little bit about what's going on, why the Fed is prioritising employment over inflation, if you think that, you think this 98% chance is going to happen, and also any reason that you think that the Fed rate cut might not occur?
Yeah, look, I think, as you said, 98% of people think, 98% think that there's going to be a Fed cut. I will have to be part of that 98%. I think there will be a Fed cut. It's been signaled that there will be Fed cuts for the last, well, pretty much the whole year. Even before the last one, there were already reports saying that there might be one or two before the end of the year, and then another one early in 2026. So I don't think it should be any surprise to anyone that there's talks of Fed cuts, and it looks pretty certain that there will be one. And obviously, since Trump's come into power, this is one of the things that he's really pushed for. It's lower interest rates, although that might cause inflation to rise again. He's trying to lower borrowings, which helps with the US debts that they've accumulated over the years, and also helps consumers. House prices are very high, not just in the US, across the globe, and by decreasing interest rates, obviously that decreases the amount you have to pay back in your loan. So it helps the everyday person as well. For businesses, obviously it's quite very good. As you saw in the last Fed cut, the S&P 500 rallied heavily after it was announced, and obviously some of that rally is included with the optimism of there was going to be more Fed cuts, and now that there looks like there will be more Fed cuts, I think the S&P 500 will continue to rally, and probably keep pushing past its record high right now. If you look historically, in 8 of the last 10 rate cut cycles since 1982, the S&P 500 rose on average by 11% the next year. Obviously, the one exception was 2007, where it fell 25%. So there is precedent for a bad year, but I guess that links back to what we were just talking about with the potential stock crash. But I think for businesses, they should be very optimistic. Lower rates, lower borrowing costs, more, they can spend more, um, and yeah, it should be able to boost economic activity. Also, with the job market, I think the US job unemployment was relatively high, has been relatively high this year, and there hasn't been as many jobs created as expected, which obviously those two things combined are not a good combination for the general population. So for Trump to, I think now that Trump wants to lower this unemployment rate, get more people back to work. Yes, inflation might rise a bit, especially with the tariffs. That's that's been going on, but there's talks with, albeit the Canadian talks fell through. There were talks with Canada. There are talks with China as a framework agreed on, and later this week. So then prices in the US might come down anyway as a result of those trade talks. And so I think for Trump now to focus on the unemployment and get people back to work is the number one biggest priority, and then inflation should hopefully come down as well once these trade talks hopefully go well for not just the US and the recipient country, but it will benefit the globe. So yeah, I think these Fed cuts will definitely occur.
Yeah, I think an interesting point, which I saw someone mention the other day, was actually that there's often quite a big focus on the tariffs in terms of how much revenue the US actually goes about in terms of getting in, the negative impact it can have on countries impacted by the tariffs, on top of the US, obviously facing reciprocal tariffs in response to its own tariffs, and also the potential relationships that can be ruined. But then obviously, tariffs can also be used as a bargaining chip. And I think that's kind of been, a lot of the talk. But a side that I hadn't thought about as much was sort of the benefit for the American worker. So I think, particularly when the tariffs were first coming out, I didn't really understand how it would help the American worker in terms of if you're Apple, for example, and you need to produce an iPhone, in terms of a pure salary basis, it's going to be significantly lower in a country like China or Taiwan, and so the cost of production will be a lot lower. And then I think there was another element to that, is that when, particularly as China sort of became a global superpower in the 80s and 90s, what you had these areas of specialization built into these kind of like gigafactories throughout China. And so they're not only, can make these products incredibly cheaply, but they also have an immense level of specialization. And so their level of advancement in all the little different bits of the Apple iPhone, for example, means that China are the best in the world at actually producing these things. So it's not just the amount of cheap labor that it would cost, but also, the benefit in terms of specialization. But despite what you think with regard to whether the tariffs were a good idea in terms of use as a bargaining chip, and you see companies like Apple investing a lot into the US, and you can have your sides on both sides. What it has done is it has reinforced Trump's focus on a lot of his electorate in terms of his focus on the American worker, in terms of actually giving middle class people a job and a pension, and actually putting in steps and policies in place in order to give them a better future. The reason I mentioned that is I think that's an important thing which I haven't seen actually, I haven't heard of many jobs and stuff actually being put in practice. So I'm interested to see what's happening from, you even saw Mark Zuckerberg have a meeting with Trump at this long table. And he was like, how much are you going to invest, Mark, in the US? And he was like, 600 billion. And then the kind of hot mic went off and he was like, oh, well, was that the number you wanted me to say? Not to say he won't do that, but to an extent of which, will these projects actually happen in the 2 or 3 years that Trump is still president of the United States? In terms of like boots on the ground, being university students, Luke, you being in Exeter, me being at Duke in the US, I have noticed that even many of my most intelligent friends who have 4.0 GPAs or firsts in Exeter, for example, are not only struggling to find jobs, but people that would usually be at like the top banks in the planet are now not getting jobs even remotely close to that. And that's not simply obviously there's AI, which has cut a lot of the junior workforce, but there's also a lot less jobs available. And I don't think many of the older generations have truly realised what this is like. Because if you've got experience, a lot of people, because of both habitual behaviour, but also the way contracts and stuff work, a lot of people are kind of in businesses and looking for less jobs that are older. But younger people are actually finding it hard to get involved in the job market at all. And I think we're only actually at the start of these like job worries really coming about, because a lot of the people struggling the most are actually young Americans, young Brits struggling to get into the job market. So there's an extent to which you can kind of say that, oh, they're just taking a gap year, or they're working in a coffee shop, but there are lots and lots of individuals who are not actually finding jobs. So I'm really interested to see if the Fed, in terms of lowering rates, actually encourages more firms to actually going about hiring peoples, or if it actually just makes the problem worse. It kind of adds fuel to the fire. These companies see, all right, here are even more people investing in our companies. Our mandate in terms of cutting junior workforces and in terms of getting AI to make our companies more productive, the market is saying that we're doing the right thing. So let's hire less people, let's train less junior people, let's give them less opportunities, because AI is actually allowing us to automate many of the things that will be done. In terms of, in all financial crises or in terms of major technological shifts, there is always opportunities for new jobs to be created. But I don't think many of these jobs have actually come to the forefront yet. So that leads to a short to medium term problem in terms of where does this job creation come from? Where do these opportunities come from? Not just in terms of pure economic benefit, in terms of for the American worker, for the British worker, for the recent university graduate actually having a job, but actually, when you get to high levels of unemployment, that can lead to uprisings and riots and, economic instability more broadly. So I'm really curious the extent to which broader measures are taken there, and whether governments actually mandate to say you have to hire people even with the rise of AI. Luke, what do you make about the unemployment levels, particularly around recent university graduates? Would you agree with my statement to say that many people are struggling to find jobs at the moment?
Yeah, I mean, I completely agree. I think it's a pretty tough environment for a university student or a just recently graduated student to go into this job market, because as you rightly mentioned, there's just not that many jobs going around, it seems. Obviously, I was not I didn't know what it was like for university students 10 years ago, but speaking from my experience, yeah, there just seems to be every single job is so highly competitive, and obviously you'd expect that for some of the big firms, like if you're applying to Goldman Sachs or Morgan Stanley or JP Morgan, or any of the biggest financial firms in the world. You're not expecting it to be a walk in the park. It is going to be a very tough application process, but I think, I mean, I don't know the stats for this, but I'd love to see the applicants per job and if that's risen over the last few years or if that's fallen. I would assume it's risen because I feel like there's just less jobs going. Um, and it just means that it becomes so highly competitive for a lot of people. As you mentioned, there's a lot of people at universities like Duke or Exeter who are getting these top grades. Really, really, really smart people, and they just can't find a suitable job or an internship for them, just because it's so highly competitive and there's just not that many jobs going around. Um, and yeah, I think I'll be as same, yeah, really just echoing your points here, but be very interested in seeing what these interest rate cuts feel in the US, and whether that can help these young adults find more job opportunities, where where the businesses and organizations will use this to hire more people and try to bring on more junior workforce, because yeah, AI and technology has destroyed a lot of jobs. Obviously, there will be jobs created as a result in the future, but as you rightly mentioned, we haven't seen the benefit of that yet. It's still we're right at the start of this switch. I think, look, AI and technology has really come to the forefront in the last 3 years. So a lot of companies are still only just figuring out how to properly implement these tools into their workforce to create the best synergies between a human and AI, and how they can get the most out of it. How can they be the most efficient and most productive? And it's still not come to forefront. I mean, a lot of businesses, I think 76% of businesses say that they haven't seen the benefits of AI and technology within their workforce, within their organization as expected. So obviously that's a massive number. Um, so I think a lot of these organizations need to work out how they can bring those two together, how they can increase. Obviously, junior staff has gone down, but maybe how they can keep the numbers junior staff, but have them in a slightly different role so that they can complement these AI. Because AI can do a task that might take a junior analyst a day to do in an hour or less. That there's no question about that. But it's how can you use this junior analyst to go into further depth? It's or people don't want to have a report written by AI and just give, they still want a human touch. So I think a lot of organizations need to work out how to create better synergies between the workforce, human capital, and technology. And hopefully these Fed cuts will you know encourage bringing back more younger people into the workforce, into these top companies, because a lot of these people deserve their chance. They're very smart. And again, obviously, I don't know what it was like 10 years ago, but I'd feel like they would have a better opportunity of getting a job previously, and they haven't.
Yeah, this kind of links to quite a few different points. I actually I wrote a LinkedIn post yesterday as part of my newsletter. So if you listen to this, go subscribe to the newsletter. Let me know your thoughts. But one of the points that I made was directly linked to what you just said, in which in this job market you could be the best, and simply because of lack of opportunities and because of the broader market landscape, you are not gonna you will struggle to get a job, right? But 10 years ago you could be slightly less skilled than you are today, but simply just because the market's booming and they're hiring a ton of people and there's tons of opportunities, you could be hired, you know, as a less skilled worker. So it's sometimes less about what you're doing, but more about understanding the broader market. So I was using that not only as an argument to say like, oh, don't worry, keep going. Of course, like internal motivation. But I actually think these podcasts that we're doing right now, for example, it actually points to there's a needed and necessary level of understanding, not simply from a institutional investing standpoint, from a portfolio manager standpoint, or even from a retail investor standpoint, but even just from the day-to-day person needs to be able to understand what is going on in broader market conditions, because they need to upskill, they need to prepare for the future in terms of what's coming. They need to, do you need to save at this point? Do you need to invest? Do you need to, put your investments into other things? Where your money is because of what's going on in the markets. Are you, is simply applying to more jobs the right thing to do, or are there different countries in the world that are doing economically better, like South Korea, for example? Even the UK on the stock market level is doing really well, but then from an actual government level, maybe it's not doing as well. So it's these nuances and understandings that I think, not just from this podcast, but also getting a broader and more informed perspective is imperative for everyone on the planet these days. And so that's something that I wanted to mention. Another thing, going back to exactly the point that we were making with regard to rate cuts leading to perhaps less jobs. That was actually a point I brought up a month ago on a podcast I did with Louis Vincent Garve, which is now my most viewed podcast on Personable, CEO and co-founder of GavCal, in which I asked him, right, traditionally, you look at the Fed and there's kind of two metrics for how they go about making economic conditions. What is the rate of inflation and what is the rate of unemployment? And in terms of inflation, of course, unless like cryptocurrency takes over the planet tomorrow, which I highly doubt, and I don't want to happen, I highly doubt that's going to be the case. But the second question of unemployment, I think that's a really interesting one, because if you were, let's say we went back 100 years to the Industrial Revolution, And, all of these factories expanding, many people from the fields are coming into the cities, and an extra unit of labor has a direct increase on the, on how the business does, right? You have one more worker, you have one more person making t-shirts, or one more person, creating the next device that's going to be used by all of these companies. But these days, we not only had the level of automation and technological revolution, but with AI, even the services industry, you mentioned consulting, a lot of, they still want the human touch, but there's still a lot of like automated tasks, such as manually copying Excel sheets, or you go into a bank and someone has to like manually put in your card details, or whatever it is, customer service, asking the same questions over and over again. Many of these things have been automated, and so as these businesses have both saved money, got more efficient, more customers like them because they're better at what they do. There's a level of fine tuning you can put to AI and to technology versus a human being. These companies are doing better with less people. And so I wonder whether these two metrics of unemployment and inflation are actually going to be the key focus of the Fed in 20 or 30 years, right? Like, imagine a world in which Nvidia, OpenAI, and all of these companies do considerably better, right? Are we going to have like a Wall-E, the Disney film Wall-E type situation, in which kind of humans are just focused on like the enjoyment of life, and a small select people are actually controlling that system? I mean, that's a question. A sort of like rebuttal to that would be that people say that human beings always need work and something to do. And that kind of linked to my point earlier with regard to, I think there's an extent to which, even if we do well and the human touch is not needed from a low skilled point of view, that governments will actually have to mandate labour being used. Otherwise, it could cause forms of like civil unrest. In terms of where I think that a lot of people will be hired moving forward, there's been a big notion that people need to upskill. I think it's very unfair because people have no idea where they need to upskill. I think just in terms of general understanding of AI, knowing how to use prompts, just the things that we all kind of use on a day-to-day basis, with Gen Z being some of the most who would use OpenAI and ChatGPT as one of their primary search engines, versus the old generations who more habitually will use something like Google. I actually think social media is a big example of not just my bias of actually posting on social media myself, but I actually think it's a growing market. There's billions and billions being invested, obviously looking at, companies like Meta and YouTube and, through Google and Alphabet, etc. I actually saw Daniel Priestley, who's a recurring guest on Diary of a CEO, who's one of the big economic and business voices out there, say that in the next few years he expects there to be more businesses on social media, so more man on the street businesses on social media. There's sort of like mum and pup, like bakeries or pizza restaurants or whatever it will be. So I think that will be a big area of increased change. So very interesting what happens there. Scary times in the labour market. My advice would be just keep trying to do what you can, keep applying to jobs, keep keep trying to plan out the future. It's not I wouldn't want to sit here and tell you I have the answers. And I think most guests that I'd have on my podcast also would not have the answers. So I think most people are dealing with uncertainty. Something else I wanted to touch on. Actually, no, we'll go to this first. So, Luke, in a few days, Trump and Xi Jinping are going to meet. What's the backdrop of this meeting? What are some key things that they're trying to achieve? And what does this mean for the USA, China, and the rest of the world?
Yeah, so the US and China, all throughout this last year, have been sort of interlocked in this trade war. Um, there's, obviously from Trump's perspective, that he doesn't trust China as much. I think there's a recent investigation in China's compliance with the 2020 trade deal, and see if they reach the planned outputs that the trade deal suggested. So there's always this mistrust, and there's been threats of 100% tariffs, or I think even double that, 200% tariffs on China, and you know this only hurts the Chinese. This only hurts Chinese people, Americans, and just the world in general. I think it's a lot, especially you mentioned earlier actually that bringing these tariffs can help US workers to gain skills and maybe even increase employment. But a lot of Trump's voter base was rural, farmers, and they're really struggling. The soybean market's really struggling. China was their biggest exporter, and now all of a sudden they've got massive tariffs on us, and then American soybean products become all of a sudden becomes so uncompetitive in Chinese markets, and Chinese people will probably start buying. Well, the prices will be so high that Chinese people will start buying either Chinese soybeans or other countries' soybeans. So it's definitely not. It's not a good thing. These tariffs haven't been a good thing for all American workers. Um, but there is some optimism. They've reached the US and China have reached a framework agreement um, already before Trump and Xi Jinping's meeting in Seoul. So in South Korea. But I think it's a very big deal. Obviously for China, they've got quite a big monopoly on rare earth minerals, which is so important in making um, tech and AI products. Nvidia semiconductors need rare earth minerals and EVs and defense industries, and China have sit on a lot of rare earth minerals. Obviously, you've seen with the US, last week, I believe they may have had a partnership with Australia on rare earth minerals, and they're trying to diversify their where they're importing it from. But um, for China, that's obviously a massive upper hand that they have going into these negotiations. Um, and but the framework, it has been a good one. They've agreed. The US has agreed to pause new tariffs, and the China has increased the purchase, American agricultural goods, so soybeans and corn. So again, very good for farmers in the US, and which are, a lot of Trump's voter base are that. Um, and yeah, I think if you look at the implications of it, it sort of eases fears of an escalation of of this trade war. It's already at a very it's already been going on for nearly the best part of a whole year now, and it seems like so far it's only gotten worse and worse. So this framework has, at least given a bit of hope that this might be the worst of it, and then we might be on the way back down. Because as I said, of course the trade wars between US and China, but these are the two biggest um, GDPs in the world. They have a massive impact on the global prices, and by having this framework in place and hopefully bringing prices down, it will bring prices down not just in these two countries but across the globe. Um, and I think I think for Trump this will be a massive turning point. He's obviously the last after February, March, April when he was putting these tariffs on all these countries. He's There hasn't been that many new tariffs on recently, apart India last month. But the this might be showing that he's changing his stance a bit. Trying to he is concerned about inflation prices rising in the US, and this is his way to help it. And it's not just in the China as well, because obviously while that China talk is dominating the um, headlines over this tour. He is visiting other countries in Asia. He's at an Asian summit, the ASEAN summit in Malaysia. Um, Currently, I believe, which and Southeast Asia was, they have loads of supply chains in the US. They export a lot to the US. So when they hit with these tariffs, it really economically really damaged them. But also by Trump coming down to Southeast Asia and trying to, have a better. Um, I think that they're announcing to plan expand trade and security cooperation. So it's almost trying to counterbalance China's regional dominance. So it's very important for the US to be able to do this. They're having talks with South Korea and Japan about lowering tariffs. I think for Japan, the ta the main point of attack is to lower the tariffs from 25% to 15% on automobile manufacturers' steel, um, which will obviously help the big Japanese car companies. And I think this is a very important tool for Trump. Southeast Asia and East Asia is a very important region for Trump, obviously, with its proximity to China. Um, he would likes to be get some control over this region, and have foster good relations as yeah, as I said, it's very close to China, and to have trade and security cooperation within its regions will be a very positive thing for the US going forward.
I think something I was very interested in growing up was, and Ray Dalio talks about this in his book, changing the new world order, the changing world order, or something along those lines, in which basically the world orders of the past, the UK, the Dutch, go through all of them. They've kind of changed every 100 to 150 years. And so I think there's kind of been a somewhat inevitability that at some point in time, China will overtake the US. And I think what's different from the past as now is that we have nuclear weapons, and that these countries aren't just in terms of purely, boots on the ground, needing to man things. Like what we were saying with AI, you don't need people anymore. A lot of the warfare is in it's in technology. It's not simply just men on the ground. It's drones. It's big missiles, and so even a smaller country. It's why North Korea has so much power and dominance relative to how small of a country they are. Is that if you have the weapon capability, you people can't fight with you because they don't want the whole world to end. And so with the US and China, an interesting conversation I had a couple of weeks ago is that they were saying that people are often asking the wrong questions. Because the question that most people are asking is, at what point in time is China going to overtake the US, and what will be the consequences of that? When actually the question is not about the US v China because they're such big global superpowers, but it's in how do they cooperate, and how does this transition between the two adapt over time? Because they both have such global dominance that all of these different countries are so reliant on them. I mean, I've said this like for the third time now, but South Korea, the UK, Germany, all of them were reliant on Nvidia and OpenAI, which are simply just two companies within the United States. There are so many companies in China as well that the rest of the world is relied upon. And it's like with Apple, right, with that AirPods example, is that you just have these two dominant players, and the other 180 or whatever countries in the world are incredibly reliant on them. And so this deal is not simply just another deal with another country. It's also the country that changes the world order from the bottom up to that point, with Southeast Asia, as you pointed on, with the tariffs and the implications that happen on there. I think rare earths are going to be a really big topic of discussion. I think China have like 70% or more of all rare earths go through China, but only something like 9% of the world's supply are produced through the US. So the US are very reliant on China for rare earths obviously being used in AirPod cases, or in, but also in warfare, tanks, planes, any form of like specialized machinery. Rare earths are used in that, in iPhones, in iPads, whatever it may be. So they're an increasing thing. You mentioned soybeans. Yeah, exactly. A lot of the US farmers were exporting soybeans to China. That been cut off, having a big impact there. Fentanyl is still a big topic of discussion. And kind of subsequently, off the back of that, China has agreed to delay their the money that they were going to take for their rare earths, the kind of addition, the levy that they were going to have for another year. And similarly, Donald Trump has delayed his extra tariffs on China. Scott Bessent has also, set up very well with the vice premier in China for talks to happen. So I think this is less of a question of will Trump and Xi Jinping and the US and China fall out, and what will be the implications of that? But I actually think this is a necessary deal, because by not making a deal, they're also making a deal that they're actually just going to screw each other and the rest of the world. And for a very pro-business economy that Trump wants to build in the US, and also what Xi Jinping, where they've had some stunted growth over the past few years, they would want to have a China doing very well. So I actually think there's going to be an increased economic dependence on the two, even if China, if going back to Liberation Day back in April earlier this year, in which China was like, we don't need the US, we can hit tariffs on you as well. I still think that the broader implications of the market rely on the two collaborating together. Another big topic of discussion recently, Luke, was the US and Canada. Trump has stuck on an additional 10% tariff on Canada in response to an ad in Ottawa comparing Ronald Reagan saying that tariffs were bad and that, obviously that Trump shouldn't be doing them, which led to Trump saying that he's going to end all negotiations with Canada and the tariffs. What sort of, what are your initial thoughts of this? Do you think that countries should have deeper thought into their ads and how they represent other countries? What do you think of the sort of like historical and economic impacts moving forward from President Trump making a move like this?
I think, yeah, countries should have a better understanding of, what adverts are going to go out, because the advert in Ontario was funded by the Canadian by the Ontario government. Like it was proper. It was official. It wasn't a rogue Canadian business, for example, who put it up. So because I think because of that level of formality, and um, I think it obviously angered Trump. And I think if from Canada's point of view, if it's not the best timing to do this. If you're trying to work out a trade deal with the United States, it's probably not the best time to then go piss off the president of the United States over an ad. So I think that's just poor negotiation, to be honest, from the Canadian perspective. But um, yeah, look, the extra 10% tariff on Canadian products, it's obviously going to hurt. Um, Canada's already struggled a bit after the tariffs have been put into place. Prices have risen, and the previous resumption of talks would have signaled that the countries want to stabilize. Um, because they've got one of the world's largest trade relationships across all sectors, due to their historical context and close proximity to one another. So I think from a Canadian point of view, and even for Americans, by having a trade deal would obviously, decrease the costs of a lot of things, and foster a better relationship between two neighbors who usually do have quite good relationship with one another. Um, and yeah, I just think it was very strange that this ad came out. It's just the timing doesn't make sense. You would think that there would be some kind of that someone from the entire government would have been mentioned to the Canadian government before the ad went out, or someone would have alerted them anyway. And I just find it very weird that it was allowed to air. Because we know Trump, look, we know Trump. He, he's not going to look for much of a reason to feel offended by something. And I think it's just a very weird timing to do it. It's not. Um, it's yeah. It's Canadian Prime Minister Ken is at in Malaysia right now, but I don't think they're going to speak at all. Well, there's no plans on speaking about the tariffs there, and it seems like a bit of a wasted opportunity from the Canadian perspective, um, because you know it, Donald Trump is not known to forget about grudges, and he can hold a grudge for a while. So it just seems it's all a bit odd to me that this occurred, and again, hopefully that there will be a trade deal for in the future, as that will benefit the Canadian people and Americans as well. But until they stuff like this stop happening, I don't no, it just won't happen in the future, and there's no desire from Donald Trump's side to restart these negotiations now, which is a massive wasted opportunity, as I said.
I think something that I often, or that many people don't often think about enough, and was definitely a question and something that made me go, oh, that makes a little more sense after Liberation Day. So going back earlier this year with Liberation Day, when Trump announced all the tariffs that were going to appear in all of the countries, there was a big question of why is America fundamentally changing the relationships that it's had with countries for 50, 100, or hundreds of years? Many of these countries are allies of the US, and people, that give the US, they have military bases together, mutual economic interest and growth, and many of the businesses, many of the multinationals work in both of these countries. They hire American workers, they buy from America, they sell to America, right? These are all things that are important for the US economy. But something that I was brought to light by me, and it kind of changed the way I thought about things a little bit, was the GDP of the countries. Because let's say you and I, Luke, right? We're good friends. We're equals, right? Even if you were richer than me or I was richer than you, there's no real, there's no real impact to that relationship. But let's say that if you were 10 times richer than me, and you had 10 times the population than me, I don't think that we should have equal terms. The reason I would say that, as someone coming from the UK, obviously I want the UK to have the best trade deal it possibly can for prosperity back at home, is that you've got 10 times the population of people that you need to look after. And every time you give me a better trade deal, if we have the same trade deal, you're negatively impacting the people of your country. So you're choosing, if I have 1 unit of population, you have 10 units of population. If you're giving me favourable terms, you're favouring my 1 unit of population versus a tenth of your whole population in terms of, how many things you're exporting from that country, how much economic gain they can also get from the US. And so whilst there is obviously economic benefits to trade, there's those basic economic advantages of looking at comparative advantage and how the world does better if it trades with one another. The US GDP is so much bigger than many of the other countries in the world that I don't think people actually think about it. So I even just pulled up right now, the US GDP in 2024 was 29 trillion. And this other country, China, that we talk about the whole time, its GDP is 18 trillion. So it's almost half of the US, the next biggest titan. The press always paints the US versus China. The US is almost double the amount of GDP as China. And then you look at and you put the US and Canada on the same level. And obviously we've had trade agreements between Mexico, the US and Canada before. The US GDP, as I just said, being 29 trillion. Canada's GDP is only 2 trillion. And so there's an extent to which you could say, oh yeah, Canada, Mark Carney wants what's best for Canada and Trump wants what's best for the US. And of course that's true. And of course they want to have, good relations. But with the US's GDP being 15x of that of Canada, the level of respect that needs to be given, of course have free speech, of course have what you want to believe, and share that with the world. But the level of respect that you need, especially from a government organisation such as the Ottawa government, during times when you have a president who's much more tuned in to what's going on the boots on the ground of what people are saying. If you have, me and you again, you're 15 times richer than me, I am going to have to make decisions which appeal to that 15 times. I'm not even half of you, I'm 15 times. The US has got 15 little countries more than I do as an individual. And so I think that level of respect needs to be given. So I think it's definitely unfortunate what's going on with Canada. And I do think there are, respect needs to be given to countries and to allies. But at the same time, I think people need to understand the world economic order that we live in is that this is not free speech within the US and what the US wants to do, but this is free speech in another country. And when you're actually going about dissing a country that you want to have a favourable trade agreement with, I actually would argue that Trump did the right thing in terms of putting on a tariff, because if you're talking down the US brand and the US image, then that's got to have consequences. Otherwise, it can kind of lead to a slippery slope. Two more quick topics I wanted to mention just before we close out. One being there's still an ongoing government shutdown. It's now on its 24th day, which has delayed the release of critical economic data, including the non-farm payrolls report. The Bureau of Labour Statistics recalled furloughed workers specifically to release the CPI data as is required for Social Security adjustments. And another stat that I thought was really interesting, before I ask you for your final thoughts, Luke, is a JP Morgan study covering 2003 to 2022 showed that a fully invested portfolio returned 9% annually. Missing just the 10 best trading days in that 20-year period dropped the return to 5%. And missing the 30 best days resulted in a 0% return. So I think that's very interesting, as it shows how important it is to actually be in the market. Luke, any closing thoughts with regard to those two things, or any other news points that you want to add, or things that you want to talk about with what we've talked about today?
I think that last report's very interesting. I mean, I wouldn't. I guess. I've never given it much thought as to how much of an impact these big gaining days are to your portfolio. But I wouldn't have expected the top 30 of what was it 20-year period
Yeah, so
to
yeah.
yeah, top 30 days of 20-year period to, and if you miss those days, you 0%. Yeah, I would not have expected that. So I think that's quite good food for thought. And it just shows the importance of, um, if it shows the importance of, if you're investing in some like an index fund like S&P 500, or if you're watching this abroad and, whatever the index fund of your own country may be, I think it shows the importance of just keeping your money in and really focusing on a long term, because if most people aren't, the average person is not an investor. You're going to lose money if you're day trading, investing in certain, like investing in Apple, for example, one day and then taking out the next, and then going to Tesla or something. So I think it shows the importance of longevity and to really trust the process and make sure that you don't miss these dates, because as well, it shows how important it is. And with the government shutdown, yeah, it's been going on for what, 3, 4 weeks now. And so obviously the longer it goes on for, it has greater and greater impacts on, um, you know, as you said, financial reporting, but also on a lot of businesses who rely on government contracts to operate. And if this shutdown goes on, obviously I know week by week it's only costing $15 billion, but it does add up. Obviously, and what this third, fourth week now, so 45, $60 billion have been lost since, and that could be exacerbated by the prolonged period of it. So I mean, obviously, I think it's a benefit for everyone for this government shutdown to come to an end. There's no one benefiting from this government shutdown, and I think that the Republicans and the Democrats need to sort something out, because as much as they might, as the parties have different policies and different areas, I think the one thing that they both are trying to do is look out for the American people. And but with this shutdown continuing, it's doing the complete opposite. So I think they just need to come together and try and sort something out, because it's 3, 4 weeks is way too long, and it cannot go on like this.
The last little thing I wanted to add, and I touched this earlier in the podcast, and I think this is going to be a recurring theme to what I bring up, not only to justify myself and these podcasts, but also as a reason to look to younger voices, but also retail investors than just simply, the most sophisticated investors on the planet. Obviously, there's that stat that within 5 years, 60% of hedge funds fail. So you could argue that even those at the top, the majority of those people will also get things wrong. So in terms of where you get your information from, have your own level of critical thinking. With whatever information you hear from this podcast, but also from people like Jamie Dimon, or any of the top world leaders, economic leaders, whoever they are, people have the capacity to get things wrong, but also get the timeline of things wrong. So you need to educate yourself in terms of being able to understand what all this information means and where to get your information, but also apply your own level of critical thinking. Because what's different about investing compared to, say, a sport like rugby or football or golf is that to an extent in those sports, the level of time that you put in leads to better results, kind of as a constant over time. Of course, there's a level at which you go from strong amateur to professional playing the Premier League, at which there's a level of like natural instinct and, great whatever it is. And of course, you also have that in investing. But there is an extent to which many of the greatest investors on the planet do lose, do make mistakes, and do make errors. The reason I mention that point is I did an internship at a hedge fund a couple of years ago, and I kind of expected when I went in there that these people were going to be, have some sort of like secret information that only the greatest investors on the planet would know, like some different playbook or different thing that made them really special. And similarly, when I was in meetings with research analysts, I kind of presumed that I'd go into that room and these research analysts would have some different edge. But at the end of the day, in public and market investing, all the information that these investors have is out there on the internet. It's in the earnings reports, it's in the conference calls, it's in the ways that people look at things. So then you might say, how do you go about forming your edge? And a lot of people will have their edge based on, experience and the way they look at markets and in their process. But I would argue that in the last 5 years, you've been given greater ability to get an edge in terms of the amount of information you have out there. I noticed that if I spoke to a research analyst, or not only did they have their own research, but they would almost regurgitate the information that other portfolio managers had said to them from other hedge funds. So if you ask them a specific question, of course, even though they keep a degree of confidentiality, that question kind of gets regurgitated, they think about that, and then when another hedge fund manager at another bank that they're trying to provide their services to asks them a question, they might bring up your question or a version of that in terms of what's being said. So within that hedge fund world and within the institutional investing world at the very top, there's a degree to which all of that information, aside from people with their own edges, and if you learn something, a different way to look at things and don't share it, of course, that's going to be your own knowledge. But if your goal is simply to learn different angles, even as just you've got your own level of conviction, like let's say you're right 55% of the time, and you're trying to figure out how can I increase that to 60%, you need other areas of knowledge and other angles. And of course, there's an extent to which speaking to a research analyst, speaking to other hedge fund managers is a way to get that. But I would argue that retail investing is actually one of the best ways right now. So if you look at platforms like eToro, for example, you look at Robinhood, these platforms have kind of built an inbuilt social media into the platforms. So when people are buying things, apart from the pure emotional response, you can kind of see some of their reasonings. X, formerly Twitter by Elon Musk, obviously offers a real-time ability to have market news. So it's not just these kind of like highly orchestrated, very fine detailed things on the Wall Street Journal, the Economist, the Financial Times, but you can kind of see people's arguments and responses to that. I think KOSPI, which is sort of this like prediction market platform, has been really good. They were legalized during the 2024 presidential election with regard to people making their own bets, and they were legalized, and you can now bet at 18 years old in every state. You can actually look at the probability of certain events occurring. So, for example, the New York City mayoral election that's happening in a few days, Mandami has like a 93% chance of winning. But actually, if you look at this data compared to many of the polls from the presidential election, for example, it's actually been shown to be more accurate in terms of actual polling data, versus polling data. So you could look at that in terms of specific market events. And although they have a focus on those specific market events, I'm not suggesting to go invest in the platform. But what I am suggesting is to go look at these events and basically associate that with bigger market events that affect your equities or bonds or credit, whatever it may be. I think YouTube is a very important thing, because whether you think that people are chatting out their ass and just making stuff up as they go along, you might even think that Luke and I are doing that, and you'd be wrong. But if you went on YouTube and you looked at the latest headlines and things that are going on, you get a better idea of the information people are putting. Because just like voting, there's no test to see whether you should invest. So there is the extent to which the market will get things right, and as news headlines come out, the market will adjust to how valued companies should be. But if the market was always right and there was no emotional responses, there would be no market crashes, because everything would be priced correctly the whole time. Stock prices would rarely move because they'd move very quickly because they'd be at the exact price. So yeah, I'm just kind of encouraging a deeper connection to more conversations with retail investors, more podcasts, looking at X, Kalshi, Reddit, YouTube, and other forms of social media, not as your primary source of information, but just like gold and Bitcoin might be your 1% exposure in your portfolio, let them be your 1 to 5 to 10% exposure in terms of getting your market knowledge. So this week we talked about the US doing really well, but the internationals outpacing in equities. We talked about the Mag 7 expecting to post 15% year-over-year earnings growth compared to just 6.7% for the other 493 companies, the S&P 500. We talked about how gold and silver have done very well, but the extent to which they're going to continue to do well, and on an absolute level they can keep doing well, or whether there is actually a limit to which these can keep doing incredibly well. We talked about the 98% probability of a Fed rate cut, PE ratios being incredibly high, what we expect from a Trump-Xi Jinping deal, Trump's putting his additional 10% tariffs on Canada, the government shutdown, the JP Morgan study of in terms of days in the years in which you should invest, and also retail investing. Thank you so much for tuning in. Thank you, Luke, for coming on the podcast, and we will see you next week.